Okay. All right, everybody. Welcome back to week 8, our final session of It's Your Estate. Today, my name is Trevor Murphy. We were with moderator Peter Kote, and today we have trust and estate attorney Steve Bemis. We are going to be going over case studies, it's called, but it's really a sort of a review of a lot of the topics that we've talked about. Steve is a very experienced attorney and is very good on the fly with Pete, so we always like him to kind of help us at the end here. This is a good time also if you guys have questions to ask as we go, and hopefully we can get to those sort of those lingering things. Before we start, our nonprofit today is our nonprofit. We actually get to talk about our nonprofit. Pete hates talking about our nonprofit. And in many ways, we're almost like a fiduciary to the other sponsors because we give them the platform to talk about their mission, but we rarely get to speak about ours. Pete, give us a little. I got the mission up there, so you don't have to worry about remembering it. But what is the mission?
Thanks for taking care of the old guy.
But like we got the mission up there. We really would like to prevent financial elder abuse, or elder abuse by educating everybody so you're in control and you can make your own decisions. And we're hoping that if you got your financial affairs under control and you got your estate affairs under control, then you're definitely in a better position to make a charitable gift either during your lifetime or upon your passing. So Pete, give us a little background as when this started and how it's evolved a little bit.
Sure. We got started at Long Beach State University, and I got hired coming from the Financial Planning Association in Atlanta, Georgia, was my previous job. And so when I got hired by Long Beach State, the benefits in the program were just amazing. You had 110 plus companies to choose from for your 403B, which is your retirement plan in a not-for-profit, similar to a 401k, and so I went around to some of the faculty and staff and said, out of 110 companies, what did you choose and why? And quickly realized that they were influenced by salespeople, mostly insurance individuals who sold variable annuities to staff and faculty. One of the benefits of a variable annuity is that it's whatever is earned inside the variable annuity is tax-free. But in your 403B program, it was already tax-free. So it was kind of like taking an umbrella indoors while it's raining and saying, hey, I'm going to have it open just in case the roof leaks. It's just silly. And people paid an enormous sum of monies in commissions and fees, and they just didn't realize it. So when I walked away from speaking to the staff or faculty, I would go, because faculty and staff, they're really not that interested in the money. They're more interested in the education, who's the department chair and why is that person promoted, and that type of thing versus the money. And I would walk away from the meeting and go, but it's your money. And that literally is how we got the name of the program. And then we eventually called it It's Your Estate because it goes hand in glove. And so that's how the program got started.
So you got both series there. And then so that went on for many years. You were sort of doing it. How did you get other charities involved when you were doing this for Long Beach State?
Well, when I left Long Beach State, I went to the American Red Cross, Orange County chapter, and there wasn't a community as Long Beach State was. Long Beach State had 5,000 faculty, staff, so it was in a community in and of itself. Red Cross was a community-based organization. Not only that, if you just have one charity involved, then it becomes almost like a sales program. And the whole idea about learning about money, estate planning, death, when you're talking about death, you don't want to come at it from a sales point of view. You want to come at it from an educational point of view. And so the more charities that are involved, it meant that, one, we could market the program to many more individuals. And two is that we're not selling the American Red Cross or Long Beach State University or any not-for-profit. And so whatever the charitable interest is for the person, that's what we are interested in, because there's been numerous studies done and people are happier when they give. The more you want to think about yourself and your own ego, you're not going to be as happy. So the idea is to allow money and your estate and charitable planning for you to be in charge of that. And what I find is a lot of times is that people depend on other individuals to make decisions for them. And the longer you stay in charge and you use other people for information and to help you make decisions that are trustworthy, again, you're going to live longer, you're going to be happier.
Good. Well, and then so that went on for a while, and then I got involved about 8 years ago. It's been that long. Sort of helping you put the programming into a 501c3. So it can be.
Well, your background as in the Peace Corps, your background in running the not-for-profit in Costa Mesa, helping out kids get their college education, working with boards of directors, and also your desire to become a fiduciary worked out perfect as a partnership and to get you involved in the financial and estate literacy.
So the partnership was sort of where I was helping Pete kind of get. There's a lot of, I don't know if anyone's ever started a 501c3, but it's not like the IRS just hands you a tax ID. There's a lot of work involved and a lot of, in our particular mission, we're talking to people about their money and their estate, and it's not like we're, saving the starving sea lions here. So it took a while to get the tax ID. We got really scrutinized and made sure that we weren't some sort of scam operation and so forth. So, but fortunately, we eventually got the tax ID, and we've really, I think, evolved as we've gone. We've been very fortunate to keep, that we've had some long-term charitable sponsors, and then, some come and go. Our sites have been pretty loyal, but sometimes we have to move around there too. But before COVID, we were at 11 sites live, and then we sort of pivoted to this online platform like most people. So I think it's gone well, and like I said, we're tiny. We really are small, but
my dream is that it'll work. These particular programs will work in any community across the country. Yeah. And the idea being is that there's no sales involved, and that we have good people presenting, and because people, where do you learn about money and estate planning?
Yeah.
I mean, it's, in Newport Beach, you can go to the 5 Crowns and get a workshop if you like, or but an attorney,
no, thank you.
Where do attorneys don't do, hey, let me educate you first on on estate planning. And hey, if you want to pay me, fine.
Yeah. Well,
It just doesn't happen. So
you're making us look bad, Pete.
Yeah. Well, there's no, I mean, we like all the nonprofits, everyone that's involved with us, you know, all of us are volunteering. Our board, myself, Pete,
Don
Vivred, who helps us with our philanthropic
I mean,
topics.
he's wonderful.
But we still, like any nonprofit, need funds for operations and stuff. So if you like the series and you want to support, there's no pressure to. You can, on our homepage, you can donate here just using the PayPal thing.
Okay, let's get into the program.
Yeah, see how he hates it when I do that. Anyway, he's all like embarrassed. Okay, let's get into the program. All right.
Okay.
So, whoops, hang on a sec.
All righty.
Okay, so, I'm gonna tune off. We're gonna quickly go through. We've gone through this for 7 weeks, but we got this for Steve. So go ahead and take it away.
Yeah. First of all, remember that a blank Ask First form is on the first session. So when we try to recruit presenters, or when I try to recruit individuals for my clients, I use a blank Ask First form to get the basics. Does that give you everything you want to know about the individual? Of course not. But it gives you a little bit more than the person is nice, okay? And it's important that the person is nice. And one of the nicest people you're going to be meeting right now is going to be Steve Bemis.
Well, thank you for having me, Pete. And I want to point this out to all the people watching, is that it is absolutely a fair question to ask on the first phone call right out of the gate. How much do you charge? How do you charge? Do you charge a flat fee for what maybe I want, or do you charge an hourly rate? I try to get that conversation out there, early on, just because, and I hope that most of my lawyer colleagues are the same way.
No,
I don't want there to be any surprises. I'm trying to develop a relationship, a working relationship with the clients, and a part of that is being upfront and
how you charge.
And
by the way, for a lot of attorneys, this is very difficult to do. So to talk about how they charge, let's get right into it. 22 years as an estate planning attorney. Your father was an attorney as well, so you learned kind of from. Did you talk about legal stuff at the dinner table?
Not so much. I always looked up to and respected my dad, and that's probably why I followed him into the law. And I was lucky enough to also work with him as a lawyer. And I'm sure I'm biased, but I thought he was a brilliant trust, estate, and tax attorney. And so I've kind of carried on, hopefully, his legacy well. And probably 80+% of what I do is estate planning related, whether it's preparing estate planning documents, or helping someone after a family member has passed away, or even doing a little bit of litigation in this area as well. And then probably some of the other things I do kind of are just an offshoot of that, helping people form LLCs and corporations and family businesses and things like that are typically related to the estate planning.
Yeah, one of the things that attorneys only can provide is their time, because you don't sell toasters or anything else. So the only thing you have is your expertise and time. If Trevor, could you scroll down just a little bit? So you're in Newport Beach, and I look at your fee for an estate planning services, and that doesn't sound like Newport Beach.
That's kind of my range for, I'd say, my typical client. My typical client has a house and some investment accounts, some cash, sometimes a little more, sometimes a little less. So I find that that range is kind of fair, for the typical client that I get. So, 1,500 to 2,500. I mean, there are exceptions to that. There's cases where I'll do it for a little less. Some cases where things are complex or there's lots of assets where it'll be a little bit more. But I think that's, probably 80% of the estate plans I do fall within that.
And do you give, if somebody gives you a call, and do you offer any kind of free time to a prospective client?
I do. I don't have a formal free consultation policy, kind of like what you see in the commercials on TV, but I'm happy to offer a free consultation, whether it's on the phone or if we just meet the first time and we decide it's not a good fit and you go in another direction. I'm not going to charge you for that initial meeting.
Okay. What I like about Steve is that he uses this as a more of a calling than as a business. We could probably all use a little bit more business sense in our practice, but I like the fact that that's not the first priority. And there are law firms out there that all they care about is the revenue. And so I try to stay away from those major law firms and let them handle some of the $1 million plus estates.
Yeah, well, and I think the free consultation thing is a very fair question and should be asked. I've had, I just hear feedback from clients who've maybe dealt with other lawyers, and sometimes they're surprised when they get a bill for, for talking to them on the phone or this or that. So again, in any professional relationship, I think it's a fair question, how much do you charge? And sometimes I don't know what the cost will be, but it's not unfair to ask me, what do you estimate or what do you see here? And I'll do the best I can.
Let's get into the outline. Today is going to be a kind of a review of the 8 weeks. So now that we have an understanding of the terminology a little bit better than before, let's go through it. The basic estate planning documents is all about giving another person legal authority to act. And we're going to find out, as well, hopefully we did find out, how title to assets is so important. So first of all, give us a brief overview. What role does a will play in an estate plan?
Yeah, well, the will is what I'll call the most basic estate planning document that covers what happens after you die. Now, modernly, when people have trusts, the wills kind of take a back seat. But even if you have a trust, you're always going to have a will, because if you have any assets that are titled in your individual name, your will is going to be the document that determines who's going to be the beneficiary of that asset. And then your will is also going to name an executor, and that's the person who would be in charge of administering and distributing your estate, assuming it passed by the will.
And so that comes in as far as how do you have title to assets? So what's really common that I see anyway, that people have a joint tenancy with right of survivorship for their real estate. Is that the best way to have title if you want to avoid probate?
I mean, probably need more information, but in most cases it's not. It's a little over simplistic, given usually all the family dynamics and what if this person dies first and so forth, and joint tenancy just doesn't do a good job of dealing with that. And then joint tenancy with a husband and wife can have some income tax consequences that we can avoid if we are titled in a different way.
So, okay. And so the for a single person, should they have what essential documents should a single person have?
Well, I'll start, and maybe this is a different opinion than you hear otherwise typically, Pete, but I'd say almost anyone who is an adult, okay, even if they're 18 years old, should really, at a bare minimum, have a durable power of attorney and an advanced healthcare directive, because often the biggest challenge happens in the event of incapacity. And incapacity can often last, and I've seen it for, a lifetime, okay? 10 years, 20 years, 30 years. And with those two documents, we can often avoid having to get a court involved in the case of a conservatorship, so that someone else that you can take care of and make the necessary financial and healthcare decisions for someone who does not have the ability to make those decisions for themselves. So those two documents are critical. As I often say, when someone dies, we ultimately will figure out and get the assets to the people who are entitled to them. If they have to pay a little more money, it's a little more expensive because they have to go to probate or something like that. It's not the end of the world, but during incapacity, it can be a huge challenge.
So we're talking about the durable power of attorney and the word endurable. Why is that so important?
Yeah, you don't see, I don't even know if I'm saying the word correctly, non-durable powers of attorney very often, but what durable just means is that when you become incapacitated, the power of attorney still works. So most power of attorneys are durable, just because that's typically the intent, is that once you become incapacitated, that's when we really need it to work.
Okay, talk a little bit about immediate and springing, and what are you recommending today?
An immediate power of attorney is one where you give someone else the power to act on a financial transaction now. It doesn't have to wait until you become incapacitated. Whereas a springing power of attorney is one that the power of attorney doesn't give the other person authority to act for you until you become incapacitated. Usually the power of attorney will have a provision that says the agent or attorney in fact has to get a doctor's opinion, usually one or two, depending on the circumstances. Almost in all cases where we're dealing with husband and wives, especially, I prefer the immediate power of attorney because sometimes it can be challenging to get the doctor's opinions that you need. And then you're asking a financial institution to accept that doctor's opinion. And sometimes they get skittish, especially when it comes to powers of attorney.
Yeah, absolutely. You want to run your durable power of attorney by your financial institutions to make sure that they will accept it. Many financial institutions will not accept documents that they see for the first time if it's more than a year old now. It used to be 5 years, but today they're even more skittish about a durable power of attorney, and they want you to complete their form. Should an individual complete their form even though they have one that you drafted?
My advice would be, it depends on the circumstances. If you're getting up there in age or you're having some health issues, I'd say, yeah, it's a great idea. It'll ensure that you're not going to have any trouble down the road. If you're younger, healthy, maybe you can wait on it. One of the issues I see, having reviewed a few of the financial institutions' power of attorneys, is sometimes they will conflict with your power of attorney that maybe your attorney drafted, or it will replace what you had there. So one thing you're going to want to make sure is when you do use the financial institution's form of power of attorney, that you might want to run it by your lawyer and just say, is this going to revoke my other power of attorney that I need for other transactions, or do they kind of act in concert, so that they're both valid, and the one for the financial institution is only valid for that particular account. So.
Yeah, and I try to stress the point that estate planning is not literally about death. Incapacity. I have a client who got into an auto accident at the age of 27. She's now 55. And so it could happen at any age, and having a durable power of attorney is just essential. So
Yeah, and it can come up for the littlest of things. I mean, I just got a call yesterday from an accountant whose friend, who was also an accountant, has a little accounting practice and had a traumatic brain injury, is still living. Um, and the husband wants to go terminate the lease at this little office space that she has. And the landlord will let them terminate. However, there's nobody with legal authority to sign the termination notice. And so we're left with this prospect of, if she continues to live, of maybe owing rent on this office space going forward, because we don't have a power of attorney, which would have solved this particular issue. So it comes up, and even on the smaller things, and then the dollar amounts we're dealing with don't really justify going to get a conservator or taking some sort of legal action. So just having this simple document can pay huge dividends.
Yeah, and a conservatorship is the court giving you legal authority to sign that document. But this is after, today here in Orange County anyway, you're looking at over a year before you even get into the court, and then you're looking at $10,000 to $20,000. So it's not a happy circumstance. You need to have these documents. We're not living in Iowa. We're not living in Kansas, where it's a small town. This is a population of 3 million, and everybody looks at the documents to see whether or not they're not going to get sued or be liable for doing something like breaking a lease.
Yeah. I mean, what I would say is, even if you don't know whether you want a will or a trust or anything else, go online. There's California has a statutory power of attorney, and the Advanced Healthcare Directive in California is also a statutory form. You can find those, fill them out. They're kind of a check the box form, and they will serve its purpose for most things.
Yeah. The Advanced Healthcare Directive, that's another essential document. It has nothing to do with money, just has to do with healthcare. Right now, most hospitals will not even admit you unless you complete one. And 10 minutes before you're about to enter as a patient in the hospital is not a great time to fill one of these out. Okay. It takes a little bit of time to the medical field is an industry. And here in Orange County, I mean, we have Hogue and St. Joe's, and we have Providence, and it's a mess. I mean, it's just a thorough mess as to who's in charge and what's going on a daily basis. So you need an advocate, somebody who knows you as to what you want. And does a person have a right to die in the state of California if they want to end their own life?
I actually don't know off the top of my head, Pete. I'm guessing you do, but
you don't.
Okay, yeah.
Unless you have, we're going to do a program on that, but you just need the two hardest things, I think, for people to discuss is death and money. And this is what estate planning is all about, because you deal with both. And it's one of the reasons that people don't do an estate plan is, why do you, well, let me ask you, Steve,
Sure.
Why do you think people procrastinate putting an estate plan together?
I 100% agree with you. You don't want to think about your death, your demise, and what's going to happen. And this is why people put it off. And it's funny. I always look back to, I was in law school and my estate planning professor said, what's the number one reason people do estate planning? People came up with all these ideas, and it's like, no, they're going on vacation and they're getting on an airplane. Is usually there's some trip, they've progressed in life a little bit, and one of the husband or wife says, I'm not getting on the airplane until we get our estate plan. I get lots of calls saying, hey, yeah, we're flying to Hawaii on Friday. Can you, whip something together, or can I just shoot you an email telling you what we want to have? And just because I sent it to my lawyer, it makes it legal. And it just doesn't work. And in most cases, obviously we'll try to get something done on an emergency basis, but in many, we just can't get all the information we need and arrange for a signing and so forth.
Yeah.
Short
Or even
notice. So
people deciding as to who they're going to have as their fiduciaries, who's going to be their executor, who's going to be their attorney, in fact, who's going to be the successor trustee. And then you want more names than just one name. So lots of good reasons to procrastinate, but gosh, you need these documents. Highly recommend that you complete that Your Way booklet along with the Advanced Healthcare Directive. It's not a legal document, but it gets the conversation started about how do you feel about death, and allow yourself to change your mind. Since we're only going to experience death once, nobody, and they don't come back and say, hey, if I had to do it over again, let me give you a little advice, and this is the exact way as to how to do it, and it was totally comfortable for me, so you do it the same way. Well, those kinds of conversations just don't happen. So there's a lot of fear and anxiety, and that's normal. And so and doctors have just as difficult time talking about death as all of us. They put their pants on the same way as we do, but they need to hear from you or through your advocate as to what you want, how you want it, when you want it, and where you want to be. So let's go to the next page. Living trust. It's probably, if somebody comes into you for an estate plan, I would say, I'm guessing, you tell me, 80 to 90% of the time they include a living trust.
Yeah, I'd say most cases it's even more than that. I for many years I had a few holdout clients that didn't want to do a trust because they didn't want to change title of their assets, but ultimately they change their mind and we get into a trust. Yeah, a trust is one of the best ways to, number one, avoid probate when you pass away for the transfer of your assets to your intended beneficiaries. And then it also, as you've often said, Peter, it works very good in the event of incapacity as well, for managing your assets. Sometimes works better than a power of attorney. It just appears that financial institutions are more comfortable dealing with trusts than they are dealing with powers of attorney. My guess is because anyone could go down to the, maybe not anymore, online or the stationery store, I was going to say, to buy a power of attorney form and fill it out. So that they probably see a lot more fraud with powers of attorneys than they do with trusts. So they're more comfortable, utilizing trust in the event of incapacity.
Yeah. And remember, a living trust is a way to have title to your assets, just like joint tenancy, just like community property with right of survivorship. A living trust is a title to your assets. And you're correct, it avoids probate, but the incapacity argument is where I come from. Sometimes people have a smaller estate, $200,000 to $300,000. Do you still recommend a living trust for them, even though the estate is fairly small?
It kind of depends on the makeup of their assets. If part of that 200,000 or 300,000 is real estate, then a trust is really the only, in my opinion at least, is the best way for the transfer of real estate upon your death. If all they have is some liquid accounts and the client doesn't have a very complex distribution scheme to their, for example, it's just equally to my kids outright, they're all old enough. Then maybe we just do a power of attorney and a healthcare directive, maybe a simple will, and then maybe we have the client go set up a payable on death account or something on the various financial accounts. So it kind of depends on the makeup of the assets and how complex the distribution is.
Yeah. When you've had now 20 plus years, and including your dad, of meeting with family members, where do the problems come in? I mean, what do you see? Is there any generic? People sometimes think that it's the caregiver, the outside professional, and are people honest with you as to family issues that are going on? Because we all have them. I mean, if you don't have a family issue, you're not normal, as far as my estimation is concerned.
I agree with you there. I mean, my family included. Yeah, I mean, it's kind of hard to dig out the whole story. I will say that, and I may be, in the minority on this, that I'm a big fan of simple when it comes to, whether it's the distribution plan to the beneficiaries. If we make it too crazy and, this child has a right to buy this house, or this one has a right to live in it, and then we're going to equalize distributions, all this. The more complex you make it, then the more opportunity for issues amongst the beneficiaries or between the trustee and the beneficiaries. If someone comes in with a pretty simple situation on our desk, we want everything to go equally to our kids, and they're both adults and responsible and successful in life. I don't necessarily dig too deep as to what the issues are, but usually clients will throw out some buzzwords. I just met with one the other day. Our daughter kind of has a gambling problem. Okay, and then what
I like about that is it's because it's never my daughter has a gambling problem. It's I think or I think they kind of have an alcohol problem, or but in order to do what's best for them, you need to know this stuff.
Yeah, and I find that maybe not to toot my own horn, but maybe it's something to do with me. I try to make it a pretty relaxed atmosphere. I think usually I'm kind of getting a sense of whether it's something we need to dig into, and come up with a plan to address it. But I'm sure there's lots of cases where you have no idea, and ultimately we didn't do any planning to address what the potential issue might be.
Talk about grandchildren. Grandparents love their grandchildren and would like to benefit them and show their love through their estate plan. What's some of the issues there?
Well, I mean, typically grandchildren are younger, so if they're teenagers or younger, we need to think through, until what age are we going to hold their share of the estate in trust.
Trevor, could you scroll down just a little bit more? Go ahead, Steve.
Yeah. So, typically if grandkids are younger, we're going to use, just to use the term that you've got in the outline, a subtrust to hold their share until a certain age. I think when we're, in most cases with clients with grandkids, assuming, the kids are still living and are going to be beneficiaries, the grandchildren's shares are smaller shares of maybe the ultimate distribution. So sometimes, the smaller the distribution gift, the less likely we want to make it more complicated. And then, if in cases of very large estates where there's going to be a large distribution of grandkids, there is what's called a generation skipping tax, which is like an additional estate tax because you're leaving a gift to a grandchild. Now that's only going to come into play if you're over the current exemption, which is 11.7 million. But
what ages are you seeing families parents recommending before they give to outright to the children? It
I
used to
find,
be, like 25 or something, but now I see it inching up as I talk to parents.
and that's been my sense of the trend as well, is that it's getting higher. I'd say, very rarely am I seeing one before age 30 for the outright
Yeah,
distribution, whether it's to a child or a grandchild.
yeah.
Usually we're staggering them, maybe half at 30 and half at 40, something like that, or
I'm
half at
starting to
20.
recommend the first cut at 50, the second at 70, and
Yeah. I mean, every once in a while I get the client that comes in and says, yeah, I don't want them getting anything until age 75 or,
yeah,
it happens. But a lot of that, like, and how long you keep it, depends on the size of your estate. Does it make economic sense to keep a couple 100,000 in a trust for 20 years? It doesn't. So the larger the estate, it gives us a little more freedom to be creative and maybe extend out the life of the trust.
yeah.
There's a question, because you guys mentioned you sort of we're talking about, quote, smaller distributions for grandchildren under 21. Someone had asked, what do you mean? Like, what's the range? What do you mean by smaller? Do you mean specific distributions? Do you mean sub-trusts? What do you?
So, my rule of thumb, and I probably break this all the time when I have clients who just want to do it, is if you're not going to leave at least a couple 100,000 to a person that we want to hold it in trust till they reach a certain age, it's probably not worthwhile. Just the costs of having a trustee who's going to take trustee fees and filing a tax return every year, doing accountings, things like that, just kind of eat it up. So usually what I'm recommending for clients is if you want to make a small gift to grandkids as like a token, if they're minors, so let's say that's 10,000, 25,000, something like that, we can put in a provision that says leave it to their parent under the Uniform Gifts to Minors Act, basically as custodian, and they hold it for their kid. So we don't have a trust or something like that. And for children that are over 18, we can just leave them an outright distribution of $10,000 or something like that. But if we're going to have like a larger gift that we're going to hold in trust till a grandchild reaches age 25, 30, 40, or like Pete, his kids don't get it till age 75, then we want to have a larger amount, I mean, and I'd say 200,000 is kind of my minimum. Really, a $500,000 is
I usually recommend
really a better rule.
300,000 to 500,000 before you start thinking about sub-trust, and because like it says, it's as soon as it gets more complicated, then there's an issue. One of the things is that we used to see a lot of A-B trust. In other words, when the spouse dies, that we set up a separate trust altogether upon the first spouse's death. Is that still a viable alternative today, Steve?
Yeah, so we don't need the AB trust to save estate taxes any longer, like we did basically pre, and I forget the exact year, 2005-ish. Definitely, if you have a trust that was created and you're married before, 2005 or even 2010, you might want to look at it to see if you have an AB trust. It's also sometimes referred to as a bypass trust and a survivor's trust, and a marital trust or a decedent's trust. I mean, there's different, terminology used for it. But we don't need that complexity anymore to save taxes. There are some cases like where we have blended families, like where we have kids by prior marriages, where we still utilize that arrangement for non-tax reasons, just to accomplish the distribution that we want. But I do lots of amendments of older trusts where we take out those provisions just to simplify things. Like, typically I'd say if you're in a long-term marriage, have kids by one marriage, you're probably a great candidate to not need those types of provisions, which can make life a lot easier and simpler for the surviving spouse when the first spouse passes away.
Yeah, highly recommend if you have an AB trust or one of those other trusts that Steve mentioned, you may want to look at it again, because those were done for tax purposes, And today they're not needed. You do need to review. Once you sign that living trust, it is, as soon as you sign, that trust is in existence and is a legal entity. So unlike a will, that only becomes effective upon death. So you need to review your trust on every 3 to 5 years. And I fully endorse Steve's recommendation. Keep things as simple as possible. It's people will understand it. There's less lawsuits, less cost in moving on. There are rogue attorneys out there that will try to get you to do additional documents. And the reason for the additional documents is because they generate fees. So just be careful, understand why they're recommending asset protection trust or let's
Or LLCs for this.
a domicile in Arizona, or a lifetime legacy trust out of Alaska. We hear it all the time. It's my personal belief is that it's just a fee generating recommendation. So just be careful. Keep it simple. Is usually your best solution. What I see also is that people like to do specific gifts. Talk a little bit about that versus percentages.
So specific gifts would be like, I leave, Johnny and Judy, $100,000 each. Whereas a percentage gift would be, I leave Johnny and Judy 10% each, and then the balance 80% to somebody else. I prefer using percentages. They work well. I'd say as the gifts get smaller, sometimes a flat gift amount is nice. I'd say if it's under $100,000, for example. But as you start divvying up the estate in larger estates, the percentages also work well as the size of your estate may go up or down. And I think Pete and I both see with the clients and people we work with that estates generally go up over time. Everybody thinks they're going to die with zero. I still haven't seen someone plan it just perfectly to die with zero. I've seen many who die with negative. Okay, but they're usually there pretty early on. But so I'd say percentages for the primary beneficiaries, in my opinion, work best. Like you could do smaller gifts, or maybe a gift of a specific item. The antique piano I give to my granddaughter who plays, or something like that. But generally percentages work better over the long term, because most of my clients, they're going to live a while after this thing is created and may not get back to amend it or update it if their estate has grown significantly and we only have a specific dollar amount. So
can you review an estate plan, and let's say from an attorney from a document that you haven't drafted, and what would you charge to review an estate plan that some other attorney has drafted?
So usually if I'm reviewing something somebody else has done, I would charge on an hourly basis.
Okay.
I'd say most of the time, but this might even be part of a free consultation where you come in, you bring in what you got. Usually at the meeting, I can thumb through it and figure out pretty quickly kind of the material things that are in it. I can figure out whether you have an AB trust or whether there's something in the distribution plan that maybe I think, we could do a little better. Or maybe, lots of times I look at it and I say, it looks fine. The big part of reviewing it is, and I don't think you need to go to your lawyer every 3 to 5 years, but you need to pull it out yourself and look at it, because it's amazing how many times someone comes in and say, hey, I want to review my trust, even if it's one I did maybe 20 years ago. And they'll say, well, who's the trustee? And I'll say, well, it's Bob Jones. And then they cringe. Yeah. He's still in there, And often it's because children were younger, the relationships were different. But even more important, almost than reviewing the trust document every 3 to 5 years, is to review your assets, every 3 to 5 years. Because if you've acquired new accounts, are they entitled in the name of the trust?
Title.
Title. And Pete, I didn't get a chance to chime in at the beginning. Your organization, these classes, I've been involved with for, I don't know, I was going to say maybe 10 years now. They're just so good and great. And you focus on a lot of the things that I think, as a practical matter, cause some of the biggest issues. And, title to assets is one of those that I know you guys spend a lot of time on. And, whether or not this account is in the trust, or you bought a new house, did you title it in the name of your trust? Because those can cause some big issues. I just had a client the other day who came in, his wife passed away, and there's 2 properties that his wife inherited from her mother. I didn't do the original estate plan, not that it matters, but he's got 3 properties, and half of 2 of them aren't in the trust, even though the other halves that they already owned are in the trust. So now we're going to have to do a probate for halves of 2 properties, because at the time that they were distributed from mother's trust, either the lawyer at the time or whoever prepared that deed, didn't ask the question, well, do you have a trust? Do we want to put it in it?
Yeah, have we seen the same thing on IRA designation forms, that they don't put in a contingent beneficiary? And so if the primary beneficiary, mom lives longer than the daughter, and there's no one else listed, which means if it's over 166,000, we're going into a formal probate. So
yeah, and I've even seen with parents' trust. So like a parent will pass away, and it usually happens in the case where there's only one child and one beneficiary. They just keep the account in mom's trust, okay, and then that person passes away 20 years later, and they've never moved the account from mom and dad's trust into her own name or into her own trust, and we don't have a trustee of mom and dad's trust anymore who's living to be able to distribute it all the way down the line to whoever the beneficiary of the child's trust is. So we got to go to court to get a trustee, and clients are often in shock when we have to do these things. I hate being the bearer of bad news in some of these cases,
Well,
but
I have a question. There's someone's been advised from their attorney that was talking about a disclaimer trust, that rather like to consider changing the AB trust into a disclaimer trust. What is a disclaimer trust, and what's the advantage of doing it that way?
Yeah, so what you typically refer to when you hear the disclaimer trust, it's basically an AB trust, but you have the option of doing it and don't have to make that decision until the first spouse has passed away. So a disclaimer trust is good from one sense, in that if the law changes or this or that, it still gives you the flexibility to be able to use an AB trust to save taxes if the law changed in that direction. I mean, my general opinion is I don't think it's going to change. I don't think they're going to get rid of what's called portability, even with all the potential changes that may happen. So the AB trust probably isn't going to be necessary. But yeah, I have no problem with the disclaimer trust. It accomplishes the same thing. There was a time period, I want to say back in the early 2000s, where I did utilize disclaimer trusts for several clients, because we maybe needed the AB trust, and the exemption was going up every year a certain amount. We didn't know where it was all gonna shake out. So it can be a good tool for that and provide some flexibility. The disclaimer trust does have some limitations in that, in order to utilize the benefits of the AB trust, if you need it, there's some strict rules that the surviving spouse needs to go by, and time periods to be aware of. But it is a good tool that provides some flexibility.
And if you're going to review your trust, focus in on 2 areas. Okay. One is the trustee selection. Are they still living? Are they still in the neighborhood? Are they still competent? Um, uh, if you named a friend, think twice. I wouldn't do that to a friend, uh, you know, because they have to deal with the family and all the things that administration they have to accomplish. The second thing is look at your distribution again. So the rest of the trust is pretty much boilerplate, but the distribution and the trusteeship, that's uniquely yours and to your situation. And Steve's recommendation is to make sure that all your assets are titled correctly is really a great idea. Let's go to the next page. Trevor. Taxes, your assets are going to receive a step up in basis. So the good time to sell assets is after your death, not prior to your death. There's rumors that the step up in basis might go away. Boy, I certainly don't see that, but who knows? You have any opinions on that, Steve?
Yeah, I mean, my email inbox is filled every day with all these programs and things about all these changes that are coming. You know, I kind of take I'll believe it when I see it. It is a hot topic, whether the step up in basis, you know, the capital gains and, you know, are an area of focus. So we may see some changes there. I've just noticed historically, you know, everybody's always concerned, well, the estate tax exemption is going to go down and this is going to, you know, everything's going to change. I think there was about, I forget what year it was, where the estate tax was going to go away and then revert back to a lower exemption. So we did a bunch of gifts and ultimately it didn't change. So, you know, I've just found that historically, at least in the estate tax world, you know, the exemptions have never really gone down. Okay. They keep going up. The step up in basis is, you know, is more of an income tax issue. You know, it might get tweaked a little bit here. You know,
but don't do anything today. It's nothing is law. Everything is gossip, and hey, nobody knows what is going to happen. So,
and that's kind of my general. I mean, every once in a while I get clients who are really, if there was something you were going to do anyway, like some gifts, some significant gifts you were interested in doing, then maybe it makes sense to do them now before some of these changes take place, or if they take place. So, but I wouldn't necessarily create a gift or make a significant gift that you weren't otherwise planning to do on the idea that maybe the law will change in some way that'll be detrimental.
Guys, there's a question. It says, who would you recommend to be your executor/trustee if you do not wish for a family member or friend to perform these duties?
So in most cases, it's you know, a professional trustee. And
Trevor, are you the one that asked this question?
Yeah. Do I have to pick between Peter and Trevor here?
Yeah.
I have proof I did not ask the question. It's there written there for everyone to see.
Yeah, I'm just kidding. Yeah, there's 60 professional fiduciaries here in Orange County. So I would pick a professional fiduciary over a friend, and that's go away, Trevor. I would pick a professional fiduciary over an attorney, over a CPA, over a friend, just over a trust company. Just make sure you interview the individual who's listed first, so you understand their character. And that's the most important thing. This is not rocket science work, but if you're not familiar with it, it can be arduous, and you're dealing with family issues. So diplomacy is very highly important. Steve, do you want to add anything to that?
Yeah, I mean, I'll admit with most of my clients, we're not going in the direction of professional trustees, but I'd say more and more in my practice, I'm seeing situations where it makes a lot of sense. And just as an example, generally speaking, I see my clients being happier with individual professional trustees, someone like Peter or Trevor, as opposed to a trust department at a bank. They often have big trust departments that'll act as trustees. Um, just to give a little bit of props to, I've worked with both Peter and Trevor in many cases, and I'm obviously biased, but they've both, the amount of attention that they give to my clients, and this is even before they're even acting as trustee, because like Peter said, if you're going to hire an individual person to be your trustee, and usually there's no fee until you pass away or become incapacitated, but they'll take the time to meet with you, and so you can get a sense of who they are, and it's also helpful for them to get a sense of who you are and what your assets are and maybe what some of the challenges will be. And even in some cases, they're great at making recommendations as to how the trust should it be administered and distributed, knowing from their experience where some of the challenges may lie.
Do you ever use a trust protector in your document, Steve?
I don't. I just feel like it's one more cook in the kitchen.
Okay.
And could there be a situation where having a trust protector is helpful? Absolutely. But
Yeah.
I don't put them in as a matter of course.
Okay.
The way I look at it is that, we're confident enough in the person we're naming as trustee. Let's let them drive the ship without having maybe another person looking over their shoulder. The beneficiaries are already looking over the trustee's shoulder. Do we need some other person to also be looking over their shoulder or have some power over the trustee, or to make some sort of decision to override the trustee?
Real quick, guys, there is a question about what is a trust protector?
So a trust protector, it can mean lots of things, but in most cases, it's a trusted friend or advisor who is given the power to, in some cases, I want another person other than the beneficiaries to be able to get accountings and object to accountings, or maybe there's
hire and fire the trustee.
sometimes they're given the power to hire and fire the trustee. In other cases, there might be a special asset and they don't want the trustee selling it unless the trust protector says it's okay. It can really be kind of any kind of power. You see them more in trusts of people that have a high net worth. But
oversee assets in the Bahamas or wherever.
Yeah. I mean, I've got high net worth clients. I haven't used them, or at least found a need. Sometimes in more complex estate planning and income tax planning trusts, there are some tax decisions that we don't want the trustee to have the power to make because it causes a tax issue. So we give that power to a third party that doesn't create a tax issue. So
what you should be getting out of this is that an attorney has a lot of tools depending on your family situation to make the trust work for the family. So keep that in mind. IRD.
One last thing. Sometimes if we have co-trustees, like let's say we have two co-trustees, we'll have a trust protector to break the tie. Okay, like in a vote, something like that can also be useful.
Yeah, but it is another chef in the kitchen. Income in respect to the decedent. People have just a very difficult time understanding this. Assets that are in your IRA, 401k, SEP IRA, 457 plans, those are the assets. If you're going to give to charity, those are the assets to use because charities don't pay income taxes. So commercial annuities, when you give those away to a child or another individual, they will pay income taxes on those when they receive the money. Same thing with an IRA account. So make sure you understand IRD. Don't listen to the pundits as to the future of estate and gift taxes, because they are rarely correct. It's a way to generate a lot of buzz and a lot of activity, and a lot of it goes away as soon as the new law gets enacted. If you're going to give to charity and you're over 70 and a half, give it from your IRA account. Okay. Most seniors are not itemizing. They say now 65 to 70% of people over 65 do not itemize. So your gifts to charity don't get any kind of a tax deduction. But making gifts from your IRA account is just one of the best ways to do it, because it doesn't come into your income for your adjusted gross income. Charitable remainder trust, think of them when you have a low basis. Hey, I bought a stock for $10,000. I bought Bitcoins for $10,000 and it just turned into 2 million while I was sitting here talking to you, Steve.
Yeah, he brings this up because I had a client with basically the same story recently.
So it is, when you sell that, you incur an immense amount of tax. So if you have a low cost basis asset and it's highly appreciated, take a look, run the numbers, call Dawn. It's a charitable trust can be a very effective tool. It also is I think you're going to see more in IRA accounts as a testamentary gift, because you can't stretch out that IRA over a lifetime anymore. But a charitable remainder trust, you can. Most CPAs, attorneys, brokers, financial advisors, insurance folks are not familiar with charitable remainder trust. On an annual basis, Steve, I bet maybe 1 or 2 charitable remainder trusts you do.
It's actually way less than that for me, Pete. I don't come across it that often. And part of the reason is that the estate tax exemption has grown so high. Yeah. So I'm not getting as much charitable activity in order to save estate tax anymore. But there's an income tax benefit to this as well, as you point out. If you're charitably inclined with your estate, then these can be some great
Take
tools.
a look at it. Yeah. Next page there, Trevor. How are we doing on time, Trevor? You need to give us some clues here.
About 20 minutes, Pete.
Okay. We talked about the charitable gift annuity, the CGA. Again, it's a fixed income. I've seen people use the CGA as gifts to their housekeeper or to their a friend. It's a great way to give them income for life, and you can do it testamentary. That means at death or during your lifetime. It's a great tool to kind of make a charitable gift and also to receive income. Make sure you review your beneficiary designation forms. Major issues there. Probate is avoided. So many attorneys don't even look at beneficiary designation forms or even ask about them, because they're not one of the 4 documents that an attorney drafts. Do you find that you have to ask for those beneficiary designation forms, Steve, from your clients?
I don't typically ask to see them, but we definitely talk about them. And I have the conversation and advise them, look, call your financial advisor and confirm who the beneficiaries are. And it's very important, because those do get stale often over time, and circumstances change, and it can create some issues.
Yeah. Don't put down my beneficiary is my estate plan. It's not, sometimes it's not the best to name a living trust, but individuals should be named.
Yeah, typically, if there's a minor who's going to be a beneficiary, then sometimes it's better to name a trust. So there's certain cases, but if you've got adult beneficiaries, it makes sense to name them as individuals.
Yeah. Let's go to the next slide, next page. We've already talked about the first things. Organize your assets. I doubt how many clients come in and have a complete listing of their assets this way, with title, cost basis, and market value. But if you can do that, it would be an immense help to your attorney and to yourself. What we see is a house with usually houses should be titled in the name of the living trust. How would a deed read with a trust as title, Steve?
So it would usually have the name of the trustee followed by the name of the trust. For example, John Doe, trustee of the John Doe Family Trust or John Doe Living Trust, usually followed by the date. And the reason we put the date on there is to distinguish your trust from any other John Does that may be out there. We're hoping that you didn't sign them on the same day. So it's just one other way to kind of distinguish there. So that's the reason that we do it that way. So yeah, trust assets, our title is taken in the name of the trustee of the trust. So, that's why we like to see the name of the trustee followed by the name of the trust.
Okay. The Apple stock for this particular couple is in joint tenancy. And it has a cost basis of $500 and a market value of $100,000. What's the issue there as far as title and taxes are?
So this is a husband and wife, which I presume it is because they have a trust.
Yes.
And there's a joint tenancy. So in order to get that step up in basis that we talked about earlier, the asset either needs to be community property or it needs to be the separate property of the deceased spouse to get a step up in basis of the whole thing. Otherwise, if title is just in joint tenancy, that step up in basis will only occur for the half of the first spouse to die. So we've got this really low cost basis. We would like to be able to get a step up in basis for the whole 100,000 of current market value if one of them passed away. So usually we can do that through the trust. If the trust is the owner of the Apple stock and the trust says that it's community property, that's enough to satisfy the IRS. In many cases, even if it is joint tenancy, we'll take the position that it's community property, but the law is, is pretty clear that joint tenancy assets don't get that 100% step up in basis. They just get a step up in half. So
a situation where we talked a little bit about before, but the parent dies and they have a bank account and they inherit the bank account and they leave it in their own name, and it's $300,000. And so the question is that of the assets above, what assets are going to have to go through probate?
Yeah, so it's going to be the bank account, and when it says fee ownership there, that just means individual ownership. There is an exception in California if it's under 166,500, but we're over that amount. So we're looking at having to probate, that particular account.
And if you're a beneficiary of an IRA and it says the estate, does that have to go through probate?
It does. So you're correct. I missed that there, Peter. Yeah. So when the beneficiary is the estate, that means it's going to go through probate. The probate estate, your will distribute that. And in this case, given that they have a living trust, it's just a long way around of getting it into the trust that has time and expense associated with it.
Yeah.
So there's a question, and we don't talk about this too much in our series, Pete, but I think we should talk about it a little bit. proceeds from life insurance policies, are they included in the estate value or are they excluded from the estate? If the person is the owner of the policy and the children are beneficiaries, that's sort of the situation. And this is not a life insurance, an ILIT. This is just a regular policy.
Yeah, so life insurance generally is included in your estate when we're calculating the value of your estate to determine whether or not it's going to owe any estate tax. So the more specific rule is life insurance is included in the estate of the owner of the policy. And in most cases, like if I took out a life insurance policy and designated my wife as the beneficiary, I am the owner of the policy. There is some opportunity to play with the owner of the policy to make it so that the life insurance proceeds are not included in the estate for estate tax purposes. Often we can use what's called an irrevocable life insurance trust to do that, but in most cases, life insurance is included in the estate for estate tax purposes, which should be distinguished from the fact that the receipt of life insurance proceeds in almost every case is not income. So it's not subject to income tax, as distinguished from the estate tax.
So, so we talked a little bit about that, which assets have to be probated, and it's the bank account and the proceeds from the IRA are going to go through probate. And here the person put together an estate plan, obviously, and yet you had mentioned, what do you review in your estate for estate planning purposes? And I said the documents, and you made the comment, no, take a look at your assets and how you have them titled. And here's the perfect example of that. Okay, before she died, she wanted to make a $50,000 gift to her children. What assets should she use and why?
Well, generally when we're making gifts, we want to gift high basis assets as opposed to low basis assets. We'd rather have you die owning low cost basis assets so we get the benefit of that stepped up basis. So here, the only high basis asset that she has available to make a gift to children is the inherited bank account, cash, presumably. And so probably here I'd recommend, giving cash. Her estate is not going to be subject to estate tax based on the current exemption. So we'd rather her die owning her house and the Apple stock. And in order to make a gift out of the IRA to her kids, she's gonna have to pay income tax to pull it out and then give it to the kids. So, here it would probably just be cash gifts would be the recommended way to do it.
Yeah, very simple. And then and the gift tax, did you say that she would owe gift tax?
So the 11 point, so there's two gift tax exemptions that exist. There's the $15,000 annual exemption. Okay. So everyone can give $15,000 a year to as many people as they want. Here, if it's a husband and wife, they could give $30,000 a year gift tax free to each child using the annual exemption. But here, let's say that there's two spouses and so for each child, they would go over that amount by 20,000. That would just eat into the estate tax exemption, which is the 11.7. So
basically all they have to do is file a gift tax return and they will owe zero tax.
That's correct. You just got to tell the IRS that you've used up part of your lifetime exemption because you went over the annual exemption.
Right. Okay. The house was left in kind to her children, which we're going to see probably more of because of Prop 13 and 19. People are very confused on this, but the house was the house was left in kind. In kind means that. What does in kind mean there, Steve?
That just means that you're going to give them the actual physical house as opposed to selling it and distributing them the proceeds from the sale.
Does the beneficiaries have a choice of taking a asset in kind or having the administrator of the trust sell the property?
In most cases, at least that I've dealt with, it's the trustee who decides, often has discretion. And in most cases, trustees are going to liquidate assets because we get the benefit of the stepped up basis. There's no tax consequences for doing so. And however, if the beneficiaries agree or want to take an asset in kind, most trustees will cooperate to try and make that happen. But I have seen situations, very rarely do I draft a trust that says you have to give them the actual property. We actually, in some cases, do the opposite, and we say the trustee has to sell it because we anticipate arguments or disagreements. So that's one way to eliminate that potential issue.
Yeah. Well, the son is single, receives government benefits, and leaving the house to him would give him some place to live. And the person wants to have his sister take care of the house. Is there anything more on the bottom, Trevor, or is that the entire case? There we go. Thank you. The daughter sounds like she's totally competent. She's a CEO of a company, $5 million in revenue a year, and she was named successor trustee. Tell us a little bit about what you see as potential issues in this scenario.
Well, if the son's receiving government benefits, anytime someone who's receiving benefits inherits an asset, it creates a potential to cause those benefits to terminate. And so there is planning that can be done within your trust using special needs trusts and otherwise to try and deal with that situation. Secondarily, naming the daughter as the successor trustee sounds like she is very capable. It would be a good person to do so, but you could also argue that maybe she's too busy. Okay, being trustee of a trust is, at least in the initial stages, is a lot of work and time, and so maybe she doesn't have the time to do it. Secondarily, do you want the daughter being the trustee of her brother's trust, which can create some conflicts if she's holding the purse strings potentially over his particular assets. And then having siblings be a partner on a house for the long term, sometimes it works, sometimes it doesn't. Also, you run into issues generationally speaking. I have this one client, for example, this property I think it has a Carl's Jr. on it, was bought by great grandparents. There are 29 different owners of great grandkids and grandkids who are on direct title on the deed. So every time they sign a lease renewal with Carl's Jr., it requires 29 signatures on the lease. So sometimes if you have a situation like this, it can make sense to plan for an entity where there's control, like an LLC or something. And sometimes we don't do it while the parents are alive, but we wait, the kids get together and say, hey, there's 5 of us. We want Johnny to basically be the manager and operate it. So they'll get together and form an LLC. So we don't have 29 different owners as this property passes down generationally.
Yeah, it's a very simple situation, but it has an immense number of issues that somebody has to consider. And when you leave 2 children or 2 of your kids who haven't maybe talked in quite a while and they've lived separate lives, all of a sudden now have to come back and make major decisions as to what to do. For example, one person lives in the house and the other person doesn't. And what if one person wants to sell and the other person doesn't? It creates an immense amount of complexity, and you want to keep things simple because this is hard to do.
Yeah, it's in most cases I'm not requiring a property be sold, but when the beneficiaries want to cash out, like I had a situation recently where this is before Prop 19, where one of the daughters who was more well off wanted to keep dad's property. It was valuable. The property, he bought it, 50 years ago, and close to the beach in Seal Beach, and she wanted to keep it, but her two sisters just they wanted the money, and there was really no cash. It was just this $3 million property, and ultimately I advised her. She was the trust. I said, I think you need to sell it. There's just no way around this situation. So.
Yeah, or somebody who has multiple properties and then they want to leave. Well, this property ought to go to this child, and this other property ought to go to this other person, and yet they want everything to be equal. And then forcing a sibling or a beneficiary to keep the property, those are tough issues.
Yeah, I find that like when we keep properties going, that part of it can be okay. We can sometimes find a way, but often the trickier part is funding the expenses of the property, and where's the money going to come from? So sometimes a lot of people don't think about, well, if I leave this person, let's say a life estate in a property, and then your trust says they have to pay the property taxes and the insurance, but we don't leave them any money and they can't afford it, right? So we got to think of both sides of it as to how it's going to work.
Yeah.
I'm going to try. A lot of people, well, screw it. I'm going to put my video up. Hi. A lot of people with properties, I've learned, think that if they leave their kids the property, that their kids it's going to be this cash cow. They'll rent it out, they'll split the income, and everyone will win. Well, what happens is, remember, Prop 19 now, as it said, that unless the child lives in the property, you're going to get reassessed to fair market property value. Okay. Not only that, please remember the marginal tax brackets for irrevocable trusts, which this house will now be titled in, are compressed. So after $12,500 look, the income's going to be distributed out to the beneficiaries. But if the trustee's not on top of this and making sure that it's all done in a timely manner and all above board, you could end up, paying more in taxes. And so that sort of profit margin that you're thinking of when you're alive doesn't always work out that way after you die. So you have to really crunch the numbers to make sure that that's going to be feasible.
Yeah. Well, we're kind of at the end of the program, and we're ready for any Q&As or questions that someone may have.
I've been there've been a lot of questions today. I've been doing a lot. Someone did want to do a kudos to Dawn for bringing the qualified charitable distribution to everyone's attention. They said that it's super easy to set up for the financial institutions for your required minimum distributions from your IRA. Saves taxes for not being included in your adjusted gross income. So thank you, Dawn. You are making an impact.
Okay. Well, what I wanted to mention is that I don't want to see anyone take this program again. Get your estate planning done. Okay, get it over with, and that way you can get on to many other more important things in life than worrying about your estate plan. And that way you only have to look at it once every 3 to 5 years and to see whether or not it's still up to date. Steve is learning how to golf, and
no, he's pretty good golfer from what I hear.
And life is about enjoyment, and all these things are important. But once you get them done, you can move on to other things. I see one more question there.
No, she says she enjoys hearing the changes, taking the program more than once. I think what Pete just doesn't want you to procrastinate if you haven't done this yet. However, because remember we took a poll at the beginning, about 50 little over 50% of you had an estate plan, the others don't. But even if you have an estate plan, I mean, a lot of times, you know, you may have gone through the process years ago, or you don't remember what you put, or you don't really how to use the documents or to inform your fiduciary or your children, whoever's serving for you, to wield them on your behalf. So whether you have an estate plan or whether you don't, I think the series is really important to understand, you know, sort of how the documents work, how they're drafted, how to talk to your attorney, how to create one, and sort of the pitfalls that all of us have. And I think everyone needs one. It's not, you know, the It's Your Money series. Yeah, I mean, you can argue some of us don't have, you know, the money to invest yet, or this or that. But this series, everyone needs an estate plan.
Anyway, that's a good note to end on. Steve, thank you so much for participating. Love having you here at the last session. It's great. And
Well,
Trevor,
thank you for having me. It's always a pleasure to come here. And contrary to what you said earlier, it actually was nice seeing some familiar faces back when we did these in person from time to time. So I don't begrudge anyone who wants to take the class multiple times.
Yeah.
So, oh my God, I'm getting some. Hang on, Pete. Can you donate to charity if the R&D is from an inherited IRA?
yes.
Okay. And is a gift taxable to the recipient? No. I assume that means for the charity. No.
No, charities do not pay taxes. That's
Okay.
one of the reasons why a charitable trust is so wonderful, because whatever happens in that charitable trust is non-taxable. So you can turn a non-income asset into an income-producing asset without a capital gains tax.
But
And
they're talking about a gift to like a person or somebody else.
Yeah.
Yeah. In regards to, I had a question about where do I get the handouts. You go to the website and go to the materials page off on the workshops. There's a materials button, choose It's Your Estate. And then you go down to, all the handouts are here, but you go down to week 8 and it'll all be there. And then there's some more articles that you can, that Pete's put up there. And then the webinar will be posted up as soon as we can get that.
some of the articles on there are older, but I think they still are valuable as far as the point that they're trying to make. So skip through them. They're not very long, and hopefully you'll find them interesting and thought-provoking.
Okay. All right. Well, thank you everyone for attending and all the feedback. We really appreciate it. We will be starting up again in the fall of this year, 2021. So please keep a lookout for our programming that will be coming up. And have a great summer and stay safe and enjoy the reopening of everything. I know I will.
I'm
Okay.
the happiest guy here. Thank you, guys.
All right.
Really
thank you.
appreciate it.
All right.
Bye-bye.